But as for what we're seeing, the impact of Omicron on the economics, well, at the moment, we're in the dark. The latest actual economic data we've got about the early impact of this sort of thing is the PMI surveys that came out in the middle of that covered the survey period, covered the middle of the month. And we had some Eurozone consumer confidence data out as well. Both of them came off a touch, as clearly showing that the virus concerns are having some impact on the economy. But in a sense, that's old news. Those data covered before the period of the latest restrictions coming into force across Europe, also before the latest surge in coronavirus cases. So we're a bit in the dark on that front. And economists have tended to lean on high frequency indicators, daily data on things like mobility and people's movement and people's visiting workplaces and retail and recreation sites and so on. And that data is rendered pretty much useless by the seasonal distortions of the festive period. So we really are a bit blind at the moment. The key data releases that we'll be keeping an eye on come out next week. That's the full month PMIs we have coming out. We have the economic sentiment indicators for Europe, as well as the US payrolls numbers next week. So we get some hard data on the impact in December next week, and hopefully some of those seasonal distortions will drop out. But in terms of the forecasts, in terms of what it means going ahead, that rather really depends on how governments react. So far, as you say, we've had the UK government, or particularly for measures relating to England, be very, very light touch. And that light touch approach is something that's been replicated across many of the European countries. Germany's gone furthest ahead in this regard in terms of closure of cinemas as well and theatres, as well as the likes of nightclubs. But still, we're in very light touch territory compared to where we were a year ago with Delta.
So, first of all, I hope your flatmate gets well very soon and isn't having too severe symptoms. But then moving on to the broader Omicron, again, I hear what you're saying about the high-frequency data and about how it's left us quite blind and with huge oscillations as well. The hard data we're getting in the next week or so, what's that going to do to firm up or otherwise your interest rate expectations?
So I think in terms of interest rate expectations, I think we're going to need more than just next week's data to really change the picture, the outlook for interest rates over the next year. I mean, we've quite clearly over recent weeks seen a hawkish pivot amongst major central banks in the world, led most notably by the Fed. And of course, the Bank of England was already surprised, having already led markets up the garden path in November to a rate hike that never was, then went ahead and surprised markets with a rate hike in December. It's quite clearly the case that at the moment, central banks are putting more weight on above target inflation, significantly above what they were forecasting and what, let's be frank about it, what any of us were forecasting many months ago. As well as the fact that they seem to have just become more concerned about the second round effects of higher inflation today, given that labour markets are tight. It's clearly the case in the US. The US is sort of in a league of its own in terms of how tight the labour market there is and how strong wage pressures are. But let's not forget the likes of the UK and Canada are not particularly far behind in that regard, and that's why central banks elsewhere are also getting quite cautious. So I think next week's data won't move the dial in terms of the interest rate outlook, which is that most of the world's central banks will continue to, or start, raising interest rates next year, with the notable exceptions that the ECB, I believe, will sit this one out, and that the People's Bank in China will be cutting rates even further than they did back in December.